Okay, let's take a look at company A. So we have sales price $100 per unit, variable cost 40, contribution margin per unit would be 60, right? 100 minus variable cost to give us 60 per unit. This is contribution margin for A company. And then the ratio we will calculate it by what? 60 over sales, which is 100, will give you 60%, right? So 60% means per dollar of sales revenue generated from selling these units, you're getting 0.6, 60 cents of contribution margin in order to cover fixed cost. So having that concept, then what is the break-even in units? So we have $72,000, and that $180,000 will leave it till target operating income. Because remember, break-even point, we're using 0. So the goal for a break-even in units will be using 0. So that target $180,000, that will be useful for the last one. Okay? So, but still, we need to cover fixed costs, so use this divided by 60, contribution margin. So you should be able to get 1,200, yes. So that's the break-even units, meaning company at least has to sell 120 units in order to not have loss. So we have this. What about break-even in sales dollars? 72,000 divided by 0.6, so this 1,200 units will turn into how many sales dollars? Will turn into 120,000, yes. Thank you. And then the last one, remember upper portion here, we're talking about break-even units, setting the operating income at 0. So for target operating income, the units that we need to achieve the $180,000 will be, again, using the ratios, fixed costs we need to cover, but now we're not adding 0, but we're adding that operating income, this target income. All these together are divided by, we'll be dividing it by 60 because now we're trying to get the units. Okay? If the problem asks you what is the target sales revenue, then you'll be using contribution margin ratio. If it's units, divided by every unit's contribution margin. So how many units do we need? 4,200. Yes, 4,200. Okay, this is company A. Now B follows the same process. So we have revenue, how much for each? 40, and variable cost 10. Every units we sell, we're able to get contribution margin 30. 30 divided by sales price, which is 40, give you 0.75. That's the ratio, or 75%. Break-even point in units, what's the fixed cost? 60,000 for this company. And then in units, so we divided by $30, which will give us 2,000 units. Okay, now break-even point in sales, again, fixed dollar amount, but divided by 0.75. How much is this? It's, yes, 80,000. And then the last question, target operating income. So we still have fixed costs. For now, we're not calculating break-even. We're calculating operating income, then divided by 30. So the last one here should be able to get 4,500. Is that correct? Okay, now for C, same thing, 125 minus 100 should be able to get contribution margin 25 per unit. This 25 over sales revenue, which is 125. This ratio is 20%, right? Now, break-even point in units, fixed costs for this problem, 40,000, then divided by 25. So this one here, 1,600. And break-even point in sales, again, we need to calculate fixed costs divided by 20%. Should give you 200,000. Last one, target income 100,000. Again, you have fixed costs to cover, and then 100,000. Okay, so these are different companies with information on sales, variable costs, fixed costs. You should be able to get what's the minimum units they need to get in order to not have loss, what's the minimum sales revenue they need to get. And then if the problem gives you, they have a plan, the target profit for next season, how much sales they need to get in order to meet that target. You mean from here? We would say the more contribution margin the company is able to get, the more the company is able, yes, later on. Because this company is able to generate for every sales dollar is 0.75. So for the same dollar of sales revenue, they're getting more, right? So which makes this ratio very important because the wider contribution margin is, the more they're able to generate profit quicker. Okay, any questions on this example, exercise?